Hello everyone. Welcome back to the Weekend Charts. Charlie Bilello here, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for more content just like it. Before we begin, if you're looking for a second look on your portfolio or your financial plan, come to us at Creative Planning. We can help with that. Go to creativeplanning.com/Charlie, fill out this form, schedule a call or a meeting, and receive a free wealth path analysis. We're going to take a look at your portfolio, at your plan, making sure you're on the right path for 2025 and beyond. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 345 billion in assets under management and advisement, and we're here to help. What are we going to be discussing today? Many things going on in the markets. DeepSeek, the big topic, I think, overall, at least at the beginning of the week. By the end of the week, not many people talking about it still, so we'll discuss that. Then you have the earnings picture here: Microsoft, Meta, Tesla, and Apple. A lot to talk about there. The U.S. economy, we got a fourth quarter GDP number indicating slower growth, but the expansion for the economy continues. Federal Reserve pausing on interest rates as expected. We'll discuss that meeting and what that means essentially for the rest of the year in terms of expectations. Houses in the U.S. are taking longer to sell, and that's because supply is starting to build up and affordability still a big factor where it's simply becoming less and less affordable to afford a home. DOGE is saying that they're saving already $1 billion a day. We'll talk about that. Using tariffs as a tool, so a little bit of a trade war, very brief trade war this week between the U.S. and Colombia. We'll discuss that. And we'll end, as we always do, with something positive, and that would be more affordable rents. Okay, let's start out the one-day panic over DeepSeek. And there was a lot of fear at the open on Monday, and it was all about DeepSeek, this new China AI model that supposedly cost 5.6 million, which is a very low sum to build, and it had some impressive results. So the fear that people were saying was, well, if this costs so little and they don't need these advanced NVIDIA chips, well, what does that mean for U.S. technology in general, and more specifically companies like NVIDIA? But I would say there's a million caveats here. We don't know if this number is actually true, this 5.6 million number. We don't know how good this model is compared to other models in the U.S. There's a million unknowns here. It doesn't seem very likely, I would say, that all of a sudden you're going to start seeing this massive spending that we're seeing across the board on this AI infrastructure just because of this one thing. And it's not clear overall. Perhaps it could be bad for NVIDIA, but for other big technology companies that are spending tons of money, like Google, Amazon, Apple, Meta, spending all this money, if it costs less in the future to create these AI models, perhaps that's a good thing because it's obviously a cost savings to them. So a lot of unknowns, a lot of speculation here about what this actually means. I think it's way too early to tell. And also you have this situation where they're saying essentially that perhaps this DeepSeek wasn't just engineered on its own, that it actually was trained off of US-based models, essentially asking ChatGPT millions of different questions and using that to create DeepSeek. So there seems to be a lot of people saying that could be the case. And you also have the situation, of course, when it comes to China, there's always going to be censorship, and people were asking DeepSeek questions like Tiananmen Square and things like that. And DeepSeek essentially said they can't answer that particular question. So a lot of questions about DeepSeek that are unanswered today. But I want to talk about the impact on the market, at least for this week. And going forward, a lot of this remains to be seen. I think it's all just speculation at this point. So the NASDAQ 100, you can see here, gap down on Monday, and then the rest of the week essentially makes back those losses as I'm talking here on Friday, essentially flat on the week, which is very interesting because there's so much fear on Monday morning over this DeepSeek situation. But for NVIDIA, we haven't seen a similar snapback. NVIDIA actually closed below its 200-day moving average for the first time in over 2 years. So it hadn't closed below its 200-day moving average since January 12th, 2023. So that should give you an idea of what an enormous uptrend it's been. If you could see back there, it was trading at around $20 a share, and today around the $120 a share. So still up enormously, even though it had a very bad day on Monday. So how bad was Nvidia's day on Monday? It was literally the worst day in history for a U.S. company in terms of market cap loss. Nvidia lost 593 billion, which was the largest single day decline for any company in U.S. history. It was more than 2x more than what Nvidia had lost last September on a particular trading day, 279 billion. So just an enormous one-day loss. And I think it comes back to a number of things. Of course, perhaps if this turns out to be true and it actually we don't need these advanced chips, which again I don't think we're anywhere near that understanding yet, but let's say the demand for NVIDIA chips goes down because of this in the future. Well, you have a stock that was trading at enormous valuations and pricing in a lot of future growth. So if that any type of thing that questions that, any type of uncertainty over that is going to cause a big move lower, because you have all of these people have huge profits in NVIDIA and they sell first and ask questions later. That's essentially what happened. You could see on both sides in terms of big one-day gains and big one-day losses, NVIDIA is dominating both sides, and a lot of this coming just in the last year. And that's in part a function of just the market size, of course, of NVIDIA being over 3 trillion before this big one-day decline. So that's a factor, of course, as well. But the other factor, I would say even bigger, is just the huge valuation that NVIDIA has, which just adds to that uncertainty. Any type of little potential negative news is going to have, I think, a hypersensitive reaction as compared to something that has a more normal valuation. And in terms of the U.S. stock market, I wouldn't say this was a huge decline whatsoever. It was a little bit over 1% on the day. This was the third 1% decline or more a day in 2025. And as you can see here in this chart, this is normal. The reasons are always different, but you're going to see many more days like we had on Monday throughout the rest of 2025. So there's going to be a lot of talk this weekend, next week, about DeepSeek, about the impact. A lot of it is really unknown. We'll just have to wait and see. I think the biggest factor, of course, is that expectations for AI, for NVIDIA, are just so high that if there's any question about that future growth, well, that's the bigger factor, and that's what caused such a hypersensitive reaction. But for overall technology, a lot of people are saying this might be a good thing. So, because if it costs a lot less to produce these AI models, well, that's cost savings for everyone except for NVIDIA. So cost savings for the big spenders on AI, like Google, like Amazon, like Meta, like Microsoft. They're going to be saving a lot of money, and that will accrue to their bottom line. So it's not clear here, even if this is the case, that it's going to be much cheaper to produce these things going forward. It's not clear overall this is going to be bad for U.S. technology stocks. Okay, let's talk about earnings here. Microsoft, Meta, Tesla, and Apple earnings last 10 years. First, we got to talk about the gains in these stocks. Always have to provide that backdrop because it's been in just an incredible 10 years for the Magnificent Seven. And I add Netflix, you have the enormous 8, and you just throw in Bitcoin for good measure to show you that this has been a highly abnormal period where the biggest U.S. companies have really outpaced everything else by a wide margin. You could see here NVIDIA 26,000+% return, Tesla 3,000, over 3,000% return, Amazon over 1,400, Netflix over 1,400%, Microsoft over 1,000%, Apple and Meta over 800%, Google over 700%, and here's the S&P 500. A great 10 years, but by comparison, it seems like almost nothing, up 262%. I have gold here at 110% gain, and overall U.S. inflation last 10 years up 34%. Of course, at the top here, Bitcoin up 48,000% over the last decade. Now you have Microsoft here. You can see it's up over 1,000% in the last 10 years. What's driving it? Well, it's compounding this enormous revenue growth, but also Microsoft has had a significant multiple expansion. But let's talk about the fourth quarter results here. 12% increase in revenues, highest quarterly revenue ever at 69.6 billion. Net income up 10% over the past year to 24.1 billion. That was the second highest quarter for net income. So highly profitable, highly efficient company, Microsoft, huge profit margins. And just look at the last decade here. In 2014, they were at 93 billion in revenue, 21 billion in net income. We've seen an increase of 180% in terms of revenue, 369% in terms of net income. How much is the stock price up? 924% over this period of time. And so what we have here is huge fundamental growth. But on top of that, Microsoft 10 years ago in 2014, trading at a much lower valuation, much lower multiple than it is today. Okay, let's discuss Meta. Blowout quarter by any measure here. New quarterly record for revenues, 48.4 billion. That was a 21% increase over the prior year. And net income up 49% year over year to 20.8 billion. That was also a new record high. So look at Meta here. What a change over the last decade. 2014, you're talking about 12 billion in revenue, 2.9 billion in net income. Now we have 164 billion in revenue, 62 billion in net income. These percentage increases are just unbelievable the last decade. 1,220% increase in revenue, 2,201% increase in net income. And they've done all of this despite the fact in recent years that they're losing just a massive amount of money on their Reality Lab division. Another $5 billion loss in Q4 2024. That brings the total losses since 2020 up to 60 billion. So unbelievable they've been able to produce this type of net income while losing that much money every single quarter on this Reality Labs division. Let's talk about Tesla here. Slowing in terms of revenue growth, only up 2% over the past year. And if we just look at automotive revenues, actually was down 8% over the past year. But these two other areas helping to lift the overall revenue number. You have energy generation and storage up 113% over the past year, and services and other revenue up 31%. If we look at gross margins, this tells an important story here. Decline over the past year, 17.6% in Q4 2023, 16.3% today. So as we've been talking about, the huge price cuts that Tesla had really hitting margins. Obviously, you have the fact that expenses are still going up, and now you have operating income from the automotive segment going down. That's not going to be good for margins. So you got margin compression. And the really interesting thing about Tesla is that its fundamentals often diverge from its share price. We really saw that back in 2020 when there was essentially a mania in Tesla stock where it went up 743%, while its revenue only grew 28%. Of course, it struggled after that. It had one of its longest drawdowns. It's actually its longest drawdown in the history of the company, bottoming in 2022. And coming out of that, but in the past 2 years, what we've seen is the price really richening again in terms of fundamentals increasing, but you have the share price increasing much more. So in 2023, the stock price was up 102%, while revenues grew 19%. And in 2024, stock price was up 63%, while revenues were only up 1%. So once again, we have a multiple expansion, not as egregious by any means as 2020. That was just unbelievable in terms of the multiple expansion that we saw back then. But once again, the situation that kind of you're pulling forward expectations in terms of, is there going to be this future growth for Tesla in terms of revenue, in terms of net income? That seems to be what investors are betting on. And perhaps they're betting on it coming out of these other areas, not just from the automotive side. But if you look at Tesla, it seems today, if we don't see that fundamental growth, definitely vulnerable if there's any negative news to a share price decline, because you have the situation where valuations once again are stretched. Let's talk about Apple. Q4 revenue 124 billion. That was a record for Apple, highest quarter ever. Net income also hit a record 36.3 billion, went up 7% year over year. You can see Apple, very different story than many of the other Mag 7 names, particularly the other big tech names like Google and Amazon and Meta, which have just been minting money, increasing their revenues, increasing their earnings at a rapid pace. Apple has been more of a story of just kind of sideways in terms of revenues, increasing their net income in large part due to buying back their stock, so reducing the shares outstanding. And you can see that here in terms of Apple with their revenues. Not a huge increase over the past few years. The total revenue for 2024, 396 billion. Yes, that was a record high, but not a huge increase over 2023 at 386. And in 2022, they were at 388. So not huge compared to these other big tech increases. And net income, you could see in 2021, 101 billion. And here we are in 2024, 96 billion. And so the big question for Apple, like Tesla, we've seen very little growth from Apple the last few years, but we've seen its share price go up significantly. So what that means is you're all of a sudden have a company that's trading at 10 times sales and 40 times earnings because the price of the stock has gone up so much more than the underlying fundamentals. Okay, let's talk about the economy here. Slower growth, but the expansion continues. So U.S. real GDP came in at 2.3% annualized in the fourth quarter. That was below expectations for around a 2.6% increase, so a little bit below it, but the expansion still continues here now, 57 months in duration, so almost 5 years, and will be, assuming that we can produce a positive quarter in Q1, and all the expectations seem to suggest that we will. So 57 months and counting, likely to hit 60 months, 23% cumulative real GDP during this time. And what was the big contributor in the fourth quarter? The U.S. consumer came in very strong. If we look at services and goods, that was all of the contribution and more in terms of GDP, 1.5% from services and 1.4% from goods. So U.S. consumer still on good footing because unemployment rate remains low, because wages are going up and have been outpacing inflation, as I've been talking about, all of those factors leading to strong consumer spending continuing. Okay, let's discuss jobless claims. We've got a big jobs report next week, and all indications seem to be there's going to be another month of jobs gains for the U.S., and jobless claims really are a leading indicator for the jobs market, and this is one of the reasons why I would say it would be surprising to me, at least, to see employment report that isn't good next week when we get that report. So lowest jobless claims, so lowest number of people filing for unemployment insurance since April 2024, 212,000 here. This is a 4-week moving average. And you can see last August we peaked and there was a lot of fear. We had that big sell-off right around the time when the Nikkei was also crashing, that this was going to be the start perhaps of a recession. That didn't end up materializing. Jobless claims trending lower here, lowest since April 2024. And if we look at the economy here, overall in 2024, another pretty strong year, 2.8% growth, following 2.9% in 2023. But this is a chart that I think it's important for all investors to look at and kind of understand what the message is. I'm showing you real GDP and I'm showing you S&P 500 returns. If you take a glance here, yes, there is a correlation. It's not zero, but it's much lower than what you might think. The changes in the stock market are much bigger in magnitude than the changes in the U.S. economy, and that's because sentiment among investors changes much more rapidly than changes in the U.S. economy, which has become a very diversified economy. You're not going to see the same types of fluctuations. So what is GDP going to be in 2025? We don't know. A lot of people are projecting somewhere between 2 and 3% for 2025. If it comes in at 2 to 3%, can you predict where the S&P 500 is going to end the year? Absolutely not. As you can see here, the last 3 years, we had GDP between 2 and 3%, very different outcomes. In 2022, we had a bear market, S&P down 18%. And then the last 2 years, we got 25% returns. And of course, back to back 25%, not very normal. And it is every time you have a 2% GDP number, of course, you're not going to get that type of return. You could see in the past, 2014, 2015, 2.5%, 2.9%, S&P up 14%, up 1%. So impossible to say what the stock market's going to do based on what you think real GDP is going to do, which is to say the stock market is not the economy. Okay, let's talk about the Fed meeting, the Fed pause here. As expected, I do this every single time before the Fed meets. In every single meeting since 2009, the Fed has done exactly what the market was expecting it to do coming into the meeting, and the market was expecting almost 100% chance that they weren't going to do anything. They were going to hold interest rates, and that's exactly what they did. They held interest rates at 4.25 to 4.5%, so it wasn't a huge prediction here. I'm just essentially looking at what Fed fund futures are saying one day before the meeting, and I'm betting that the Fed is going to do that because that's what they've done time and time again. And what I also said is that Powell is going to cite higher than expected inflation, lower than expected unemployment. That's exactly what the Fed talked about. Inflation has been trending up, as we've been talking about, moving away from the Fed's target, and unemployment has been lower than the Fed was expected. So the balance between the two, essentially, the Fed is saying, well, we're comfortable keeping rates where they are, trying to be cautious here, making sure inflation doesn't start trending up again. And so where does that leave us in terms of the Fed funds rate? 4.25 to 4.5%. Core PCE, we got a reading today at 2.8%. So still well above the target. And the Fed is viewing this as restrictive policy because of this gap between the Fed funds rate and that core PCE rate. And they're comfortable leaving it there, I think, until that core PCE rate and other inflationary measures come down. So what is the market expecting for the rest of the year? Market's essentially saying 2 rate cuts in 2025, but we're not going to get the first one until June. That's what they're projecting right now. So no rate cut at the next meeting in March, not the one after that in May. You're going to have to wait till June to get another interest rate cut. And then from there, the Fed's going to hold again until they get to December, and they're going to cut rates another 25 basis points in December. Now, whether this actually transpires like this is anyone's guess, but it's highly unlikely. We often see a deviation from this because the data is going to come in at some type of surprise. Either we're going to see higher unemployment than expected or lower unemployment than expected, or we're going to see higher inflation than expected or lower inflation than expected, and that's going to dictate in part what the Federal Reserve does. Now, looking at that PCE data here, I think it's important to note that we're having trouble making progress. So the Fed has been talking about making progress to their 2% goal. In September, I guess they viewed this as enough progress here, getting down to 2.7%. To me, it didn't make much sense, but nonetheless, they thought that was close enough for them to start cutting, and they cut 100 basis points last year. But I think you're going to need to see this come down a little bit, maybe 2.6, maybe 2.5% for the Fed to get comfortable doing another 25 basis point rate cut. And if we look at the expectations for March here, what we're seeing is high probability once again that the Fed remains at hold. Of course, you have to wait until we get closer to say that this is going to be meaningful, but 82% probability right now the Fed holds interest rates. What about the balance sheet? There was a question about the balance sheet. Powell essentially said they're comfortable still letting the balance sheet run off here. And you can see it's been a pretty sizable runoff so far, 2.1 trillion from the peak in April 2022. So the Fed's assets, so these are securities they're holding on their balance sheet, down 2.1 trillion since the April 2022. But you can see we are still, this is the lowest the balance sheet's been since May 2020. But in that few months period from March, April, May 2020, you can see just the enormous QE that went on, and it's going to take another few trillion to get back to where we were before the COVID QE. So still a ways to go to normalize in terms of the balance sheet. And for now, the Fed is saying they're going to continue to allow it to roll off in terms of those securities. Now, the big factor that the Fed never talks about, and there's never a single question at the meeting. There maybe it's a situation where they're not allowed to ask. It just seems absolutely insane to me, given what went on during 2020, during 2021 with the money supply, that no one asked about it then and no one's talking about it now. This is something to watch. We're not in a worrisome position just yet, but what I will note here is that the money supply is trending up again. It's up 3.9% over the past year. Again, not extreme. Historical average has been about a 6.9% increase year over year, but you don't want to see this really start to ramp up again if your goal is to reduce the inflation rate. And you can see annual changes here. Why do we have that big inflation spike in 2020 and 2021? Well, because we did an enormous amount of money printing, 25% to be exact in 2020 and 12% in 2021. We had never done anything like it before in history, 40% increase in the money supply in just a 2-year period. Then, of course, inflation spikes. The Fed gets religion, pulls back, actually reduces the money supply in 2022 and 2023. Inflation rate comes down, now back below 3%. And the question from here is, where do we go from here? Are we going to do just a slow and steady increase, or are we going to see this ramp up once again? I think it's going to be dependent on a lot of different factors, but definitely something to watch in 2024 as we look and hope to see that inflation rate come back down to 2%. Okay, let's talk about the housing market here. Houses are taking a little bit longer to sell. I want to run through a few charts here from Redfin, I think telling the story of why that's the case. First, the affordability factor here. It just can't be overstated how important this is. This is the mortgage payment needed to afford the median asking price home in the U.S. You can see almost at a record high here, and there's seasonality to this, so it's incredible that we're already this high. It's 8% higher than a year ago, 2,753, and that's at a mortgage rate of around 7%. So simply, that's too high for most people to afford based on their income. And what we're seeing is the supply start to build up because of this. 5.2 months of supply, most we've seen in a few years. And if you look at the time it's taking for homes to sell, it's now taking 54 days. That's the median number of days for homes to sell. You could see back in 2022, much lower, and the last few years lower than today. So just a slow transition to here in the housing market. We're definitely not seeing a big spike in terms of supply, but a slowly at a snail's pace improving situation in terms of the housing market becoming a little bit more normal. What's abnormal though still is the gap between home prices and incomes in the US. So if we look at the Case-Shiller index here, you can see the big divide in terms of housing affordability at record lows and home prices at record highs, up 3.8% over the past year. But I would note that that rate of change is pretty rapidly now coming down, and perhaps we could see it continue to slow down in the coming months. And if we look at the 20-city index, the big factor has been the big increase in prices outpacing wages. So 53% increase over the last 5 years for the 20-city index on average. The wages in the U.S. are up around 25% over the past 5 years. So that big spread has made housing unaffordable. But again, coming back to those year-over-year numbers, you can see here the appreciation is starting to moderate. And in some areas, we look at Tampa in Florida, which has been one of the hottest markets for a long time, actually down year over year. So something to watch pretty closely there as well. Okay, let's talk about DOGE. There was a post on X talking about saving $1 billion a day. We don't yet have the confirmation or detail, but they're talking about stopping the hiring of unnecessary positions, deletion of DEI, and stopping improper payments to foreign organizations consistent with the president's executive orders. And what they're saying is they're hoping to increase this to $3 billion a day. So if we do get confirmation $1 billion a day, that would be $365 billion coming off of that deficit. That would definitely be a good start. And if they could 3x that, you're talking about almost $1 trillion, which would be absolutely remarkable if they're able to do that. again, I don't want to get too excited about this until we see the actual data that this is going on and that we're not offsetting it by some type of spending this year, or perhaps maybe even a tax cut, which would worsen the deficit situation. So a good start. If they actually did $1 billion a day, I think that's obviously huge. But I want to see the data to confirm this before we get too excited about it. And here's the final numbers for 2024 in terms of the debt, in terms of economic growth, and the debt to GDP ratio here. So 36 trillion we hit in national debt for the first time, and that was a 7% increase over 2023. Economic growth, nominal growth grew 5%. So increasing the debt more than nominal growth, and the debt to GDP ratio going up because of that to 122%. You could see the big spike came in 2020, and since then we've essentially just been treading water. In 2020, of course, we increased the national debt by 20% in just that 1 year, while nominal economic growth was only 1%. So big question is, can we hold the line here in terms of debt? 36 trillion is not going away, but can we hold the line or increase it at a slower rate? Can this increase by maybe only 1 trillion in 2025? And if so, will that nominal growth make this situation better? I think for sure that would be the case. If we could only grow the debt at 1 trillion, I think that would be a huge win for 2025. It remains to be seen whether we can do it. And here's the big factor of why we need to start focusing and tackling the deficit issue. It's because it's becoming untenable to service this debt. We have over 1.1 trillion now going just for the interest on the debt alone, and that's more than we're spending on national debt, which is pretty incredible. And as long as interest rates remain high, this is going to continue to be an issue. So if we look at the national debt and we look at 4 to 5% interest rates, that's a much different situation than a few years ago when interest rates were at record low. So it's really front and center here. This is going to continue to be an issue. If we can tackle waste, fraud, and abuse in terms of that deficit, what I've called the low-hanging fruit, I think that would be a great start to really averting a crisis, which we don't want to see. So I want to talk about using tariffs as a tool, really a tool for diplomacy, you could call it, or domestic policy. But this was really a hilarious situation because it was the quickest trade war, if you want to call it that, that I think I've ever seen. On Sunday night, you had the headlines talking about we're going to have this huge trade war with Colombia because Colombia is not accepting the illegal immigrants that were in the U.S. committing crimes in the U.S. were arrested, put on a plane, were being sent back to Colombia, and Colombia were saying, no, we're not going to take them back. And then the U.S. is saying, okay, if you're not going to take them back, we're going to put a 25% tariff on all your goods, and in a week that's going to go up to 50%. Now, of course, Colombia needs the U.S. in terms of trade more than the U.S. needs Colombia, and it seemed highly likely that they would do an about face, but it happened, I think, quicker than anyone expected. Less than a day later, you have the new headline that they reach a deal on deportations and that the government of Colombia has agreed to all of President Trump's terms. So very quickly, you see this reversal here. So using tariffs as a tool, and the question will be, well, is this going to continue to happen with other countries? I think absolutely it will. It's going to happen likely with Canada, with Mexico, with China, and no one has an idea what those countries are going to do in retaliation. Are they going to agree to these demands? And I think there's just so much speculation about tariffs in terms of what it will do to the economy and inflation, but it's all just speculation because we don't really know. So it's the big unknown of what's actually going to occur. And I would say that if it follows the pattern of the first Trump administration, I think the fears were much greater than what actually occurred. There was a fear it was going to lead to a huge decline in economic growth or a spike in inflation. That didn't actually happen. And really interesting that during the Biden presidency, they kept all of the Trump tariffs that were put into place, and they added new tariffs, particularly with China, dealing with semiconductors and a lot of other goods coming from China. So interesting to see that both Republican and Democrat administrations seem to embrace tariffs as a tool and really saying that sometimes it's in our national interest to use tariffs. The question is, are they going to use them in a way that's too much or it's punitive, and it's a situation where it's actually hurting the U.S. economy, actually hurting the U.S. Consumer, because it's driving up the cost of goods. I think it's way too early to speculate on any of that. Okay, let's talk about something positive here. As we always do, we end with something positive, and that's more affordable rents. I've been saying this every single month because it's becoming more and more true. This was the sixth month in a row that rents in the U.S., the monthly rent from apartment list has gone down. 1,370 now was the national average for rents in the month of January. That was the sixth straight decline. And as we've been talking about, because U.S. wages have been going up month after month, this makes this rent much more affordable. So very different situation in the rental market for apartments than in the housing market for potential homeowners looking to buy a home. Very different situation. So you have the most unaffordable housing market to buy in history, but you have the rental market become more and more affordable each and every month. And the big factor driving that is simply supply and demand. So unlike the housing market, where there's very few homes for sale, there are many apartments where landlords are looking to rent. And you can see here the vacancy rate of these apartments in the U.S. has hit 6.9%. That's the highest that we've seen with data going back to 2019. So the expectation based on this vacancy rate is, at least for a few more months, we're likely to see this situation continue to improve, where people's incomes are going up more than these monthly rents, which is making rent more affordable. And that's a great thing to see for anybody in the rental market. Okay, we'll end it right there. Thanks everyone for joining me. Have a great weekend. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Week in Charts.